Good day everyone, this is Dr. Sivaraman of iknowindices.com. Today I am going to commence the special webinar series, My Trading System. So this is the term or My Trading System decided to make it very simple, but actually it is a unique trading system, and this unique trading system is to identify the strategies of the opponent in the market for the traders, basically the players, and try to see how exactly we can trade along with them to earn money from that other market. FX Street is celebrating the year-long 10th anniversary series, and it is successfully contributing to that of the Forex community for the past 10 years. I feel very happy to be associated with FX Street right from the start of the year. And the CEO of FX Street, Francisco Riverola, is a close friend of mine. And I thought that I should also contribute something. Besides, there are a lot of questions during the webinars and also in the blog. People asking me, since they are not able to follow my unique system and the terminologies I use in giving the explanations with regard to the market, I thought that I can compile everything and give it as a consolidated information in a series of webinars of 10, and which could probably act as a prelude for the traders who wanted to commence trading and who wanted to follow my trading style can go through that and update themselves, and they might find it useful when they come to my webinars like Asian Session Live Market Analysis webinar, the Tracking the Forex Market Together webinar, which is given in two parts, part 1 and part 2, during different sessions of a day, giving the live trade calls and displaying the results of the calls, how exactly the calls are being derived live along with that of the participants. Then also I give the blog for the past 1 year, and in the blog a lot of questions are coming, and I give the postings of the calls on a daily basis and give the updates, what is happening in the market. But still, many people find it difficult to follow me because they ask so many questions, what I mean by such sentences, etc. So I thought that I can just compile and give my trading system, basically a unique trading system which is not a conventional trading system. Thereby, if anybody listens to this particular series of webinars, could be able to follow me effectively, and that can really help them to make money from the other market. And one of the mission for me, right from 1997 onwards, is just to help the small traders. And this is an intuition, probably an inspiration. I thought that after developing my algorithm, I thought that I should give it effectively to the Forex community. And there are a lot of people who have been asking a price, willing to pay a price and take the algorithm, etc. But I thought that I should reach, the outcome of the algorithm should reach the small traders so that the small traders can really benefit out of such understanding. It is a basic, simple understanding of the market, especially Forex market, which works in all other markets also. But I am going to confine myself to that of the Forex market in this webinar series. So first of all, to start with, I will give the Forex market structure, function, and the timing. So how exactly the Forex market is structured? You might be knowing several information with regard to the Forex market structures, but we need to know the hidden information, and that is very important for us to really effectively make trading, and that can really eliminate the fear in our mind. So besides the functioning of the market is functioning 24 hours all through 5 days. You have to understand that the market has to really make several type of moves. Only then it will be able to show some surprises to the traders from time to time. So only when the surprises are created in the market, the traders will be in a position to get confused or go with the herd of the traders and try to become victim at times. And certain other traders, they try to earn or capture fortunes out of that. So there are two categories. There are people who say that market is highly volatile, it is very risky to trade. Other set of traders, they say that market is really volatile so that we can easily make money out of that. So there will be always two views in the market, and one needs to understand in which category they wanted to belong, or in which category they will be able to train themselves so that they can really make money from that of the market. So it is not difficult to make money from that of the market. I want to emphasize it is not difficult to make money from that of the market if you develop a system. So with this objective, I developed a unique trading system, understanding the strengths and the weaknesses of the opponent who are trying to play against us. And whatever their hidden agenda might be, obviously it has to be revealed in the market, and that revealing might look like a surprise. So before that, they will be having a pre-plan. And this particular pre-plan, if you are able to read, then you will be able to understand what is going to be their next move. Okay, they want to rise zero from here, then okay, we do a buy and sell trade. If you understand that system, then it might be easy for us to trade at ease. My one of the basic objective is we can do the analysis of the past market. So we can take the data pertaining to last 1 week or 1 month or 1 year or several years and identify what is the multi-years high, what is the multi-year low, and how exactly the market has turned and what are the impacts of various economic events, etc. We can study all those things, and they are all basically used for comments of the market. But basically, if you want to do an effective trading, we need to study the current market and derive from there what could be the next move. So there are various methods, namely the conventional methods like this, fundamental analysis, technical analysis. Being a applied statistics professor for nearly about 28 years, I have spent nearly about 12 years in understanding various types of statistics and their limitations in expressing the future of the market. That is namely the forecast. So when I studied various techniques, not only the techniques what you see in many of the analysts using it, I used even the multiple analysis, multiple variable analysis and principal component analysis, cluster analysis, all the other type of analysis I used in order to find how exactly the technical analysis can really help us. But I found in every type of analysis, there are certain amount of limitations. And when you have such limitations, we do not know when exactly that limitation is going to occur. I will change. When exactly the thing is going to change. So obviously we need to understand that the timing of the market is very important. There is no tool to explain the timings of the market. So if you do not understand the market timings and when exactly the fall is going to happen, when exactly the rise is going to happen, then we find it extremely difficult whether the market is going to initially correct and later on rise, or it is going to rise afterwards it is going to correct. So we need to find which is going to happen first. So with this uncertainty, we try to trade in the market, and because of that we always develop a hesitation and we try to take the positions with caution. After doing various types of analysis, we try to take the positions with a caution, and we always say that I have taken a small mini lot. That shows that amount of hesitation we have in our mind, and we do not want to take undue risk in the market. It is very nice because that sort of planning is very essential. But we need to understand that our trading decisions should be able to really fruitful, at least about 80 to 90% it should yield success. Then obviously any type of analysis we do, there will be limitations or error factor, and we have to limit the error by using the trading strategies. So if you develop the methodology to read the market correctly, the methodology to execute the trades correctly, and the methodology to manage the money properly, the equity properly, and also limit the risk and maximize the profit, we should be able to really successfully earn money from the market. So for that, we need to understand step by step all the structures and the functions of the market. You know that the Forex market, you come across the majors and the crosses, and the ratios are being given for us for the trading purpose. Suppose euro is currently trading around 1.2585. That means it is a ratio between euro and USD. With the help of the ratio, so if you go into that of the currency conversion, you know that if you give about 1.2585 US dollar, you will get 1 euro. That is what you refer it. And you find that when euro is in the numerator country and obviously divided by the denominator USD, and so when the currencies which are traded along with that of the USD, they are all referred as the majors, who are all predominantly considered as the universal currency. And I also explained with regard to the price actions and the behavior, what you come across in the market, how exactly the price actions tend to show variations from time to time. That I am referring it as a behavior. Then I am going to give exhaustively the market timings during different seasons. So if you use this particular table, what I am going to present is, you will be able to really understand what are the timings to be followed in order to effectively understand the type of moves the players could make in the market from time to time. Then you come across with regard to the supply and the demand, which is a normal factor which is considered as a fundamental factor which can really act on the market. But we are going to give more emphasis with regard to the market rigging, how exactly the players are in a position to create an artificial supply and the artificial demand, and then try to capitalize the market. So this is the first slide I want to show with regard to the majors. The majors are the currencies having universal acceptance. So US dollar greenback is a prime currency, and against which you come across euro is trading, and then you call it as a common currency or a euro dollar. Then GBP, which is also referred as the sterling or cable, and GBP USD cross, and in both the cross, and in both the majors, you come across euro and GBP are in the numerator and USD in the denominator, and they are referred as the numerator currency. Then USD CHF, which is also commonly known as Swiss, and USD yen, commonly known as dollar yen, and there you come across the currency is the denominator. So they are the denominator major currencies. So two numerator major currencies and two denominator major currencies are effectively traded in the market. Besides, you come across two commodity currencies, namely Australian dollar, Aussie USD, and USD CAD, which is also commonly known as Loonie, and Australian dollar is commonly known as Aussie. So Australian dollar is traded against USD, which is a numerator commodity currency. So Euro, GBP, and Australian dollars are numerator currencies, and CHF, yen, and Canadian dollar are the denominator currencies. So you have to understand that these are all the six major currencies with which the entire market is being made to swing. So it is not that the crosses are bringing in the swings in the majors. You please understand the players specifically make moves in the market. Say, for example, today you would have noticed that euro, they have been keeping it in the negative net change, and GBP, they quickly raised it. Even though both are numerator currencies, they have got the tendency to move in tandem, whereas they have been holding euro and gaining more levels in the case of GBP, which is referred as a contrarian move. So to find that with the help of the currencies, by making up and down moves in a varied format, the players are able to bring in the moves or actions in the case of the cross, namely the European crosses, wherein Euro, GBP, and CHF are involved, the yen crosses, wherein the yen is the denominator currency there, the other majors are in the numerator condition. Then also you come across the commodity currencies, wherein Australian dollar and Canadian dollar have got the cross formation with regard to the other majors. Then you find all these ratios indicate relative strength and the relative strength of the respective countries. That is what we refer it as the strength of Euro is always related to that of the strength of the European Union. So GBP is related to that of the strength of UK government or something like that. So invariably you find that currencies are the symbolic representation of the strength and weakness of the economic condition. That is fundamentally correct. But the economic condition does not swing from second to second. You know very well, it is a process. The economic strength and weaknesses are the process and they cannot change from second to second. So obviously what you come across as the pip swings in the market are not the true reflections of the economic condition. And obviously you come across the swings are in relation to that of the supply and demand from time to time. Besides the supply and the demand, you also come across the artificial supply and the demand, which is also referred as the accumulation and distribution. I will come to that later. So the numerator currency rise, you come across the strength of that particular currency. When the denominator currencies drop, it refers to the strength of the currency. This one need to understand as the fundamental when you are entering the forex market. Then the price action. The price action is determined in pip variation. And you know pretty well, those who have been attending my webinars, that I always use the live market code page as the reference material for the understanding of the market. So I'll also give the link here. You can open it in a browser and I will also open it in a browser for you to explain how exactly the live market code page can be effectively used to have a total understanding of the market. So here this is the live market code page offered by Saxo Bank, and so I just use this particular thing wherein the pip variations are shown effectively and also the highs and the lows are set, and which is more closer to that of the interbank feed, because if you try to use the other live market code page, sometimes you come across in the platforms the local stop-ins might show a higher high and the lower lows and things like that, because these are all the relative levels which are very important. They are being followed by the other players. So obviously we need to understand, okay, euro is the currency symbol is given, then the bid and the ask levels are given here. So currently euro is trading around 1.2583, 1.2585 is the ask. If you want to buy, you have to buy it at 1.2585. If you want to sell, 1.2583. That is how there is a spread between the bid and the ask. Besides, you come across the low and the high. 1.2523, 1.2613 are the lows and the highs for today. And you come across another level, namely net change, which shows 11 pips negative. Negative always referred in financial markets in red, and positive is referred in green. And also you come across the GMT time. So this can be enough for you to understand the market. So you can just watch how exactly the respective currencies are moving from time to time and also the respective crosses. So I will confine only with regard to that of the four majors and the two commodity pairs and some of the crosses here, like the European cross and also the yen cross. So if you see the low where the market is it closer to that of the low or is it closer to that of the high? So 1.2582 is closer to that of the high. 1.2613 has come almost closer to that, but still it has not breached. And you know that earlier that the low in the case of euro was slightly higher during the Asian session live market analysis I explained to you. And later on I will tell you how exactly the live market code page has to be effectively used. So it was higher, they breached the initial low and came down and formed a new low, and from there they had gone up. And they are not breached the high. And similarly in the case of GBP also, they breached the initial low and came down and came up all the way and they breached the high. So why they have done it like that? In the case of euro, they are not breached. In the case of GBP, they have breached it. And if you see the corresponding cross, euro GBP, there you find that 0.8391, 0.8387 was the initial high. They made a brief upward stop and above that, and subsequently they had dropped it. Now about 36 pips drop is seen from that of previous day close. That is referred as the net change. So They dropped from that of 0.8391 to that of 0.8317 in the case of Euro GBP. For that, they have to necessarily rise GBP, the numerator, in this particular cross. Euro GBP, GBP is a denominator. When the denominator goes up and the numerator comes down, obviously the ratio comes down. So these are all nothing but the ratios. How exactly they manipulate with that of the ratios, we need to understand. So in order to say, for example, Euro CHF, another cross, it is currently trading around 1.3342. The low is 1.3312. The high is 1.3378. So it is trading almost closer to that of the low Euro CHF. The net change is 12 pips negative. And if you see in this quote page, Euro has made a negative net change of 11 pips. CHF has made a negative net change of 1 pip. So when Euro has dropped, CHF is supposed to gain. Whereas CHF has also shown the drop, which is referred as a contrarian move. Because of that, they are able to bring down. So Euro has dropped more, the numerator has dropped more, and the denominator is holding, for example. Then this particular cross, Euro CHF, will also drop. So if you try to relate the majors with that of the respective crosses, then you will be able to understand, even if you become a player, you can only do that way. There is no other way by which you will be able to bring in the changes in the case of the crosses, unless otherwise there is a price action in the case of the majors. So that is how you find in most of the occasions, they bring in the price actions. In that process of price action, they try to make the contrarian moves. That is, one currency gaining against that of the US dollar, another currency is losing against that of the US dollar. When such variable move is shown, which is referred as a contrarian move by me, they are able to bring the price action in the case of the cross. So let me come back to the PowerPoint presentation. So in this live market quote page, you come across the bid and the ask. They are the tradable levels. Then you come across the high set for the day, low set for the day, and the net change. The net change is nothing but the closing price of the previous day, that is 21 GMT of the previous day. By that, the US session gets over. Then subsequently, the interbank treasury find out what is the average price traded in the last 30 minutes and fix it as the closing price. Then afterwards, the interest is applied if a position is carried over to that of the next day. Then from that particular point of price, the variation you come across the next day, the whole of next day is referred as the net change. And this net change is very important for us because there comes the limitations with regard to the banks when they are playing in the market. So they cannot straight away drop or rise 1000 pips in a given day. They got the limitations. So if you want to understand the limitations of the players, you have to understand the limitations of the banks. For the simple reason, the players can only trade in the market using the deal rooms of the banks, and they don't have any other provision. And also they pay the margin for such trades. So we have to understand, give importance to that of the net change. Then the high and the low are the simple levels you come across on a daily basis. Every day when we open the live market quote page, whenever you are able to enter into that of the trading market, you can open the live market quote page and see where the high is and the low is. And between 2:30 and 3:30, during the Japanese session, they set the initial high and the initial low. When they set the initial highs and the initial lows, you will be able to understand they are going to be used as the reference levels for the players to act in the market. How exactly they act? They try to make the market move as if it is either following the technicals or following the fundamentals. So that is how they just keep the move in such a way so that anybody who is following the technical analysis find that okay, now market is correcting, it is supposed to come to that of the support level, then probably I'll take a buy. Then once it comes closer to that particular level, it will make a very quick downward move and an upward move. Then in the chart, you might call it as a noise, but if you try to keep a limit order, buy limit order and a stop, the stop would have been triggered. So we have to identify how exactly you have to enter into the market. Simply identifying the supports and the resistance. Can we try to buy near that of the support, or can we exit out of the resistance? We have to understand only with the help of the live market code page, we will be able to really know how to at what point of price they are going to bring in the trend reversal. Either intraday trend reversals or the daily or session-wise trend reversal or a daily, weekly trend reversal, we will be able to identify from the point of the turning. So that we will be able to identify with the help of the live market code page. During the course of trading decisions, I will explain more about the live market code page. You know that market is traded 24 hours. Market is 24 hours. You know that 0000 hours it starts on a daily basis. Then 24 GMT it closes. So it is a continuous market all through Monday to Friday. So obviously the market is trading 120 hours non-stop. Understand, anybody who is making a manipulation in the market, they have to do the manipulation 120 hours. There can be shifts and things like that, but still it is extremely difficult to make it. No, even though they are here to make money from that, the traders are trying to earn from that of the market, still it is extremely difficult to manipulate all the 120 hours. So we have to understand when they are going to enter, when they are going to exit, and what particular currency they are handling at a given time. So we need to identify all those things. Are they interested in crosses? Are they handling the majors? Why they kept the market subdued now? All these things we have to question. Then you will be able to understand that, okay, this is the time they are coming in. Okay, we will also be active during that particular time frame. So we have to understand that the market from that of the very subdued move, now you find that the moves are very, very subdued. Market is almost flat. Not even 1/5 swing is seen. So that of the wild moves from time to time. So when there is a subdued move, there is no point in watching the market. When there is a wild move, you come across a very volatile condition, and that gives a very good trading opportunity. Some people think that, okay, let the volatility subside, then later on I'll enter into the market. It is something like, I wanted to take bath in the sea once the waves subside. So probably you may have to wait for a pretty long time for the low tide to happen, then probably you can have the bath in the sea. But instead, if you try to see that this sort of volatility is a very quick trading opportunity, then you need to identify what time frame such volatility are going to happen. So we have to give more importance to that of the time to enter and time to exit, when exactly the market is going to be active. All these things you can understand if you know the market can be subdivided into various time frames. Then you come across normally in the market 4 different types of moves. USD gaining moves and the USD weakening moves in all pairs. So that is a normal condition you come across. It can be called as a USD gaining move, or it can be also called as a risk aversion move. Then similarly USD weakening move or risk appetite move. The names might be different, but invariably you come across the conditions that either USD will be gaining, all other currencies will be losing, or USD will be losing, all other currencies will be gaining. These are all the 2 possible moves. Besides, the players also do another type of move, namely some currencies making USD gaining moves and some other currencies making USD losing moves. That is referred as a contrarian move. So they can make the numerator currencies to make USD weakening move. Then the denominator currencies to make USD gaining move. So that way they can make the moves in the market and bring severe rise in the case of the respective cross. Also, they can do the USD gaining move with regard to that of the Euro and GBP, the numerator currencies, and they can also make USD weakening move by dropping USD yen, USD CHF and USD CAD. So USD CAD and USD CHF and USD yen might be showing their respective strengthening moves, but Euro and GBP and Australian dollar might be showing the USD gaining move. All these currencies might be losing. That sort of contrarian moves they can make from time to time. So we need to understand whenever they are making such contrarian moves, what they are interested. So why we need to identify their interest? If they are interested in crosses, if you try to take the position in the majors, then obviously you will be holding it for a pretty long time. Till such time some swing happens in the major so that you will be able to book profit. So you need to identify that when exactly they are going to handle the majors, when exactly they are going to handle the crosses, and when exactly they are going to make subdued move, and when the market volume is going to increase, when the market volume is going to decrease, and what are the market triggering factors. All those things we need to understand in order to find or expect the next expected market move. So even may be used to trigger the market. So the events can be anything like a rumor or a data release or a speech or anything. And they are all considered as events, and these events could be used as a trigger in the market so that we will find some meaningful action for such events. So suppose non-farm payroll is being released, then obviously before that you come across the market is subdued and all are anxiously waiting for non-farm payroll release. So as soon as the data is released, the market becomes very, very virulent. It starts making up and down moves. So we need to find out, okay, it gives a good trading opportunity. I do not know whether I have to do a buy and sell trade or a sell and buy trade. That comes the biggest question in the minds of the traders. So we need to address it instead of asking somebody else, can I do a buy and sell trade or a sell and buy trade? You can judge by yourself by looking into the market moves, whether I can do a buy and sell trade or a sell and buy trade. And your insight is the utmost important thing which can give you a good trading style. So that is why I want you to develop the real insight of the market. That is why I am just giving this particular special events of webinar. In such a condition, traders ought to be done to earn quick gain or a quick loss, and they are all the potencies. So the traders invariably try to enter it out of emotions and find that the position is making loss, they have been cheated, and sometimes they find, okay, I had taken a buy position, the market has suddenly dropped and hit my stop, and later on it has gone up. My analysis is correct, but the traders fail. So this is a normal condition you come across among prevalent of traders. So how we have to come out of such a constraint? Because this is a practical constraint, so one need to address it and see that how effectively we'll be able to come out of that. Then the next I want to show is with regard to the market timing. As I have been giving importance to that of the timing, because by using the charts or any other technical analysis, we are not able to identify what is the time by which the market is going to make a drop or the rise. So obviously, it is a man-made market. When the market is man-made, it is not God-made, it is man-made in which herd of traders participate or a collective group of traders participate. And in that process, you require the market facilitator. A simple question. Suppose if the bid and the ask you come across in the live market quote page, Euro is currently showing a bid of 1.2576 and the ask is 1.2578. If it stays for about 15 minutes there, nobody will be interested to take a sell position or a buy position. Suddenly, if Euro gains about 10 pips level, 1.2590 or 985, then immediately you think that, oh, Euro is going to rise, why not I also buy? So it will give the trigger for the traders to take a position in the market. Similarly, you find that market drops about 10-15 pips. Immediately you think that, okay, market is going to fall technically or any other means you identify, then immediately you think of taking a sell position. When the market is static, nobody will be interested to take a position. So obviously the market has to be dynamic. So in that dynamic process, the swings are very, very essential. The swings are being created in the market by that of the market facilitators. And such market facilitators, they obviously the bank, they give either way quotes in the market, the buy quote as well as the sell quote. So they try to continue to give the feed and the quote and try to see that the market is able to show some momentum. And in that process of momentum, it can trigger the traders to enter or exit from the market. So obviously we need to understand the timings followed by that of the market facilitators and also the players, and why we need to follow the timings. Because obviously the banks are the market facilitators, because the orders can be passed on from that of the bank treasury. So we have to identify, or we have to understand the timings of the treasury, because they cannot make all the trading 24 hours in the treasuries, and they have that time during which they try to place the orders of the exporters and the importers, and certain other times they place the orders of the trade. So there are two different treasuries, and you find the trading treasuries and the currency conversion treasuries. So obviously you find that the orders will be pouring in from that of the exporters and the importers in various countries on specific times, and they are to be executed. Let me not go into the details of it. So you find that such orders will be coming during the start of the session and the end of the session. So if you find the start and the end of the session, then subsequently, due to the natural geographical positions of various countries, you come across certain gap times during which the banks in certain countries would have closed the official treasury operations for the day, and any of the other transactions, they will give the effective day the next day. Then subsequently, the banks in the other parts of the country, they would not have opened it. So they would have commenced their official trading or official currency conversion after some time. So you find there is a gap during which big orders from that of the banks will not be entering into the market, especially the currency conversion trade. So when such orders are not available, they are referred as the gap time. So these gap times are naturally available times, a period of 30 minutes, and they are between the sessions. So I have just named it as a Japanese session, European session, and the US session. And you can call it as a Asian session or a European or UK session, New York session, whatever it is fine. But follow the timings, they are all in GMT. So 0030 to 7 GMT, then 7 to 7:30 is the Japanese session, 7 to 7:30 is the gap time, 7:30 to 13 GMT is the European session, then 13 to 13:30 GMT is the gap time, then US session starts by 13:30 GMT and 20:30 GMT it gets over, then 20:30 GMT to next day 0030 GMT will come across the gap time of 4 hours. So these are all the timings followed during the daylight saving system. So whenever you come across a daylight saving, both in Europe as well as US, you find this particular timing is being followed. Then whenever a standard time is being followed in Europe, or standard time is followed in US, because you know that the daylight saving systems are there for about 5 to 6 months. So obviously you find that of the daylight saving to that of the standard time, again to that of the daylight saving during the summer and the winter. So obviously you find that the timings will also get altered. So when the standard time is being used without the daylight saving, the timings will be 0030 to 7:30 GMT, 7:30 to 8 will be the gap time, 8 to 14 will be the European session, 14 to 14:30 will be the gap time, 14:30 to 21:30 will be the US session, and gap time will be 21:30 to 0030. And you would have noticed that in the month of October and in Europe, they would not have introduced the daylight saving, whereas in US they would have introduced the daylight saving. Then you come across the timings of this nature. And after the daylight saving system, then initially Europe will convert it into that of the standard time. Then later on US will also convert it to that of the standard time. You find the timings all there. So anyhow, in my webinars and other places, I frequently continue to give what are the timings to be followed. But we have to understand why this timing has to be followed. Because with the help of the chart, we might be able to find the supports and the resistance. When exactly the market is going to reach the support? When exactly the market is going to reach the resistance? If you try to identify, probably you can improve on your trading. Then each session, the first 1.5 hours is the early session, and the last 1.5 hours is the late session. As I explained that the bulk orders from that of the currency conversion will be coming during that time. In between the sessions will be the mid session, and the mid session you come across mostly the crosses are being handled. So basically the majors are handled during the start and the end of the session, or the early and the late session, and the crosses are handled during that of the mid session. Then I have given a caption here. The market timings are all followed by that of the players based on the official bank opening and closing time in different parts of the world. So you have to keep it in mind. All the gap times you come across the false moves in the market. So say for example there is a gap time between 7 and 7:30 GMT. You would have seen that there is a quick gain during that of the gap time, then followed by that a drop during the start of that European session. Similarly, there might be a quick drop during that of the gap time in 13 and 13:30 GMT. Then later on, in the first 30 minutes of your session, you will come across a quick gain. So you will find always a false move before that of the intentional move in the following session. So if you follow the timing, then it will be really useful for you to enter and exit into the market. Then you know that the market functions based on the supply and the demand. The fundamental demand and the supply and the technical demand and the supply, you know very well. Fundamental demand and supply due to some crisis and things like that, fundamentally that currency could look weak, then obviously you will come across more supply coming in. Probably people exit out of that particular currency and subsequently enter into another currency which could appear to be safe. So from time to time, you will find some currency will look very attractive, some currency will be available at a very cheap rate. So obviously you know that it is because of the mechanism of demand and supply. And also you come across technically the demand and supply. Then you find that a lot of traders would have taken a sell position, and because of the short selling, then short covering could come in the market, and because of that the demand might go up. So that is the technical. Then caught data and things like that people study in order to find out whether there is going to be a demand technically for a particular currency or not. Besides, you come across the players are trying to do that accumulation by dropping the market and accumulate a respective currency, or create a bearish feel in the market and accumulate the currency at different levels. And you know the volume is so huge, obviously they have to accumulate it by dropping about 300 to 500 pips. Sometimes even they drop up to 1000 pips and try to accumulate. Then afterwards use some other story and rig the market and straight away gain the levels all the way with the help of spikes and things like that. And using the data release time as the trigger. The data might be very, very negative to US dollar, and probably, say for example, non-farm payroll or the jobless claim, etc. Whenever the data is negative, immediately you will come across a spike in euro and GBP, and they gain the levels and subsequently book profit. When the market appear bullish, the players are booking profit. Okay, then you find, okay, whenever the US data is negative, so euro is going to rise. Okay, why not we correlate that way and try to buy euro positions whenever that, as soon as the data is released. You try to take a buy position in euro, anticipating that euro has to go up. Then you will find euro started dropping. And the interpretation in the market and the media everywhere will be there is a risk aversion. US economy is really going bad. So obviously everybody wanted to enter into the safe haven. So gold has gone up and US dollar is being considered as a safe haven. So everybody is buying US dollar. You get become fooled. Oh God, when I try to relate it to that of the earlier occasion and try to use it as a reference, and it goes off. Similarly, when I try to correlate, okay, Dow is going up, so euro has to go up, and try to take a position there, next time the correlation becomes just diagonally opposite. So, because of the accumulation and the distribution, the style of operations of the players, you continue to see surprises in the market. So, let me continue in the next webinar. Its timing has become crucial. So I'll just minimize that slide and try to take up the questions which are asked here. Francisco, what advantage do you see in looking into the field? looking at the table of the code. I just minimize the PowerPoint presentation. If it looks black, so kindly excuse me. I am just going through the questions here. Codes in comparison with the daily chart for the example. Yes. Okay. When you just compare it with that of the daily chart, obviously the time factor is very important. So whether you have to compare it with that of the previous day or a previous week, previous month, previous year or multi-years. So the comparison can be of any length of time frame. And you have to ask a simple question. Can anybody take a position in euro at 1.42 and hold it for such a long time of 1 year, 2 years and things like that? And whether he is going to really come for selling once euro goes to 1.28 when you find it as a resistance, you have to question it. So probably in a leverage trading system, most of the traders try to liquidate the positions on the same day, or they just hold it for a few days and try to. Yeah, I just minimized the slide, sir, in order to read the questions. I'll just keep it open. So obviously, up to what time frame you have to refer it. And another important aspect with regard to the timing of the market. And when you try to understand that they had dropped for 1 or 2 days, immediately you try to draw a channel from that of the last week or last month and things like that. Invariably, it will look going downward. But when you try to relate it to that of yesterday, market would have gone up. And you have to identify. So for that, some people use the 5-minute chart, 15-minute chart, 4-hour chart, 1-day chart, and also multi-day chart, weekly charts, etc. So we can continue to use all the types, but which one to trust at a given time frame is very important. If you try to go on do the analysis with regard to the market, market may not wait for you to trade. So it would have already gone up and it would have proved your analysis correct, but you would not have done the trading. So obviously as a trader, you have to leave the analysis to somebody and who could be an expert in a technical analysis, and probably you can just listen to him and take it as a view, and basically you have to analyze the present market and see whether I can do a buy and sell trade or a sell and buy trade. So for that, the live market quote page is really helpful, because the players use the live market quote page just to see whether the traders have taken the long positions or the short positions. Accordingly, they will be able to. I'm just minimizing the slide because it's flickering. So that is why live market quote page is more valuable for me, because I used the charts and other things for my all comments and market analysis and back testing, etc. and found that invariably we derive something. Okay, for example, you just take last week chart and try to make the analysis of the last week chart and say, okay, Monday this is how the market is expected to open as per the chart. You give the level and see how exactly market was opened on Monday, and you will find you are disappointed. And similarly, you take the chart with regard to the US, with regard to the European session, or then you try to say that, okay, US session, I am expecting this sort of moves in the market, and just to see during the US session, you may not come across that. So ultimately, it is very useful for you to find out whether the Fibonacci retracement has taken place successfully, whether the pivot points have been respected by the market, or whether the supports and resistance are respected by the market. And that sort of understanding we can do it. But if you want to really trade, then obviously you need to find, okay, from this point, is it going to rise or drop? Or from this particular spread is going to rise or drop. And that is more important for us. And in that, the error can happen. But we have to fine tune our analysis and fine tune our understanding so that we should be able to pinpoint, okay, this is the turnaround point on the intraday basis. This is the turnaround point on a weekly basis. And that sort of perfection we should be able to achieve. And that I was not in a position to derive using the fundamental and the technical analysis which are being used conventionally or extensively now. That is why I thought that I have to really develop a unique algorithm with which I'll be able to find out the timings of the market. So, but in this particular webinar, I am not going to refer to that as the algorithm, because without the help of my calls in the Asian session or in the blog whether the market is going to come up or go up or come down. I want the traders to develop their own methodology, develop their own insight. Okay, from here they are going to drop zero. From here they are going to rise zero. I want the traders to develop that particular insight. So my entire effort is only for this. Okay, so no promotions and no business taxes, etc. Please, and it is all I am giving it only for you to develop the markets insight and understand the market in the true sense. Then, can infer gap time means always there is a false? Yes, most of the time, nearly about 85 to 95% of the time, gap time shows false. You try to see in the live market code page for several days, then you will be able to understand, excepting 1 or 2 days, especially during such state. After the gap time, there might be a data release. The volume might be very, very low in the market. Say, for example, 14 GMT, there is going to be a data release. Then obviously the gap time move may not be very significant. Similarly, 8:30 GMT or 8 GMT, there is going to be a data release from Europe or UK. Then there may not be a significant move during the gap time. Still, you will find a little bit of stop, and I will try to explain to you in the next webinar about various types of market moves. Then you will be able to really understand, and I will show you the live chart for you to understand how exactly the players make the moves in the market. I will give the projections during the webinar. You will be able to see that, okay, yeah, that's what they are doing. So because they cannot do anything else other than that, because this is the type of trading system. I have been using it from 1993 onwards, and it is working successfully. I have been giving various type of webinars, etc. in FX trade, in finances, and still the system is being followed, even though the players are not the same. From time to time, they also change. Okay. Then any other question? Can we refer to the gap time means here? Once again, refresh. Yeah, I just minimize the PowerPoint presentation in order to read the question. Time between 2:30 and 3:30 is a GMT. Yes, time between 2:30 and 3:30 is a GMT time. That's what I referred. And the GMT time is a 24 hours time, and the players follow 24 hours time. So if you also follow 24 hours time rather than our local time. So if you see in the live market code page, you come across the GMT time displayed, and obviously you can refer to your local time in the computer and find the difference between the GMT and your local time and try to tune your market reading pertaining to that of the GMT time rather than trying to take the market to your local time. Because the market is universal. It is being traded from different parts of the world. So obviously you should not become subjective of taking the market to your local time. Instead, you just perceive the market based on the timings followed by the other market. I think no more questions. I will come back again tomorrow. That is 14th GMT. Missed it. Tomorrow 14th GMT. 14th July. Between 12:30 and 13:15 GMT, I will take up the next unique trading system of mine, part 2, market triggers and surprise. So it is a 10th anniversary special edition in order to celebrate 10th anniversary of FX Street, and I hope those who are coming to FX Street are being benefited by listening to this particular trading system. Probably whichever is suitable for you, you can make use of it in your trading system. Thank you, FX Street, and thank you, participants. See you again tomorrow. Bye.